Wall Street is officially torn in two. Right now, top analysts are predicting one of two extreme outcomes for silver this year: a historic, wealth-minting supercycle to $300, or a devastating crash back to 55. The gap has never been wider, and your portfolio depends on getting this right. I am your host, John A.G. Welcome back to the Wealth Reactor. If you have capital deployed in the precious metals market, you know we are living through unprecedented volatility. Back in January of 2026, silver went completely parabolic, blowing past the $120 mark. Retail investors were euphoric, mainstream media was panicking, and it felt like the physical shortage had finally broken the system. But fast forward to today, late April, and we have witnessed a brutal 35% market correction down to the $78 range. So, was January a speculative bubble that just popped? Or is this massive pullback the final accumulation phase before silver enters a historic supercycle that will dwarf anything we have seen in our lifetimes? Today, we are stripping away the emotion, the internet hype, and the fear-mongering. We are looking exclusively at the hard macroeconomic data. In this comprehensive deep dive, we are breaking down the three distinct institutional price targets for the remainder of 2026. We will examine the institutional bull case of $135, the black swan supercycle target of $300, and the bearish breakdown to $55. By the end of this video, you will have the complete, unfiltered macroeconomic roadmap for where the silver market is heading next and exactly how you should position yourself. Let us start by looking at the immediate price action and the macroeconomic chessboard. As of right now, spot silver is violently defending the $78.25 support line. To the untrained eye, a drop from $120 to $78 looks like a crash. But to understand this pullback, you have to stop looking at the silver charts and start looking at the United States dollar and the Federal Reserve. Silver does not exist in a vacuum. It is heavily tethered to monetary policy. Early in the year, the broader financial markets priced in aggressive interest rate cuts from the Federal Reserve. Investors believed that the fight against inflation was over and that cheap money was coming back. When interest rates drop, the yield on government bonds drops, which removes the opportunity cost of holding a non-yielding asset like silver. That expectation of cheap money was the rocket fuel that helped push silver past $100, but reality hit hard in the spring. Inflation proved incredibly sticky. The cost of housing, energy, and services refused to drop to the Federal Reserve's target. Consequently, Chairman Jerome Powell and the Fed were forced into a higher-for-longer stance regarding interest rates. When interest rates stay high, government bond yields become attractive to institutional money. This strengthens the United States dollar. Because global commodities like silver are priced in dollars, a stronger dollar acts like a wrecking ball on the paper price of precious metals. It makes silver more expensive for foreign buyers, capping its upward momentum and triggering algorithmic sell-offs. Furthermore, shifting geopolitical dynamics have temporarily drained the fear premium out of the market. Whenever global tensions ease, institutional algorithms automatically dump safe haven assets and rotate capital back into riskier tech stocks. But here's the critical disconnect that the mainstream financial media is completely ignoring. The paper market is crashing, but the underlying physical fundamentals have actually strengthened. To understand this, you must understand the difference between the paper market and the physical market. The price you see scrolling on the ticker at the bottom of a financial news screen is the paper price. It is determined by digital contracts traded on exchanges like the COMEX in New York and the LBMA in London. For every one actual physical ounce of silver sitting in a registered vault, there are dozens, sometimes hundreds, of digital paper claims trading hands. It is essentially fractional reserve banking applied to precious metals. This paper market is what institutions use to suppress the price. But the physical market, the actual metal being pulled out of the ground and refined into bars, is in a state of absolute crisis. We are currently staring down our sixth consecutive year of a massive global industrial supply deficit. We are consuming millions of ounces more than the mining sector can dig out of the earth. This massive physical shortage brings us directly to our first forecast. Let us look at the institutional bull case, targeting $90 to $135 an ounce by the end of 2026. Firms like JP Morgan, UBS, and Citigroup are not panicking over this recent price drop. They are accumulating. They view this recent 35% sell-off as a textbook consolidation phase. Nothing goes up in a straight line, especially not a highly manipulated commodity like silver. JP Morgan expects silver to build a massive foundation at these current levels, forecasting a stable average price of $81 for the year, with a steady climb going into the fourth quarter. But Citigroup's data desk is maintaining a much more aggressive, unapologetic stance of $120 to $150. Their thesis is not based on monetary policy. It is entirely built on the green energy transition. The manufacturing of high-efficiency solar panels, electric vehicles, and artificial intelligence data centers is creating an inelastic demand for silver. The word inelastic is crucial here. It means these massive global manufacturers have to buy the metal, regardless of what the Federal Reserve does with interest rates. You cannot build a modern solar panel or a complex AI microchip without silver. It is the most electrically and thermally conductive metal on the periodic table. There is no synthetic substitute. These institutional bulls believe that once the algorithmic paper selling exhausts itself, the sheer lack of physical inventory at the COMEX will force a massive, violent repricing back into the triple digits. The industrial giants will demand physical delivery, the vaults will run dry, and the paper manipulators will be forced to cover their short positions at a massive loss. Now we turn up the heat in the wealth reactor. Let us discuss the most explosive scenario on the table, the supercycle view, projecting prices from $150 to well over $300 an ounce. While $300 silver sounds like internet hype or a tinfoil hat conspiracy, it is actually backed by mathematical models from major institutions like Bank of America. The math behind this extreme target lies in a metric called the gold to silver ratio. This ratio simply measures how many ounces of silver it takes to purchase one single ounce of gold. Historically, as it comes out of the Earth's crust, that ratio is roughly 15 to 1. During the Roman Empire and for most of modern history, financial systems pegged the value of the metals at about 15 to 1. Today, however, the paper market has stretched that ratio past 64 to 1. This means that relative to gold, silver is currently one of the most deeply undervalued assets on the planet. Right now, gold is violently defending historic all-time highs, as central banks around the world, particularly in China and India, hoard gold at a record pace to protect themselves against the weaponization of the United States dollar. The supercycle theorists argue that any systemic macro stress event, such as a sovereign debt crisis, a commercial real estate collapse, or a sudden loss of global faith in fiat currencies, will cause this massive ratio to violently snap back to its historical mean. Let us do the basic math. If gold holds its ground at current record highs, or pushes toward $5,000 an ounce during a global liquidity crisis, and the ratio simply compresses back to its historical average of 15 to 1, silver mathematically breaches the $300 mark. We have seen flashes of this before. During the Hunt brothers squeeze in 1980, silver skyrocketed to $50 an ounce, which adjusted for today's inflation is well over $150. In 2011, silver nearly hit $50 again. But the setup today in 2026 is vastly different. In the past, silver spikes were driven by monetary investment demand. Today, the investment demand is colliding with an unprecedented, unstoppable industrial shortage. If the physical supply runs completely dry during a global financial panic and the public rushes to buy hard assets to escape melting fiat currencies, this black swan supercycle scenario becomes an absolute reality. But to be a truly successful investor, you cannot succumb to confirmation bias. You cannot just look at the upside. You must rigorously hedge against the downside. This brings us to the bearish view, targeting a severe correction down to the $55 to $75 range. We have to respect the charts, and technical analysts are raising red flags. They argue that January's $121 peak was a massive bull trap. It was not a true physical squeeze, but rather a speculative frenzy fueled by retail leverage and algorithmic momentum trading. Now that the momentum has broken, the charts look highly vulnerable to a deeper pullback. The most critical technical threshold to watch right now is the $70 support level. That is the line in the sand for the bulls. If silver breaks below $70 on high volume, technical models will automatically trigger massive short positions, creating a cascade of selling pressure. But the bear case is not just about technical charts, it is about global economics. What happens if we enter a severe, synchronized global recession? If the economies of the United States, Europe, and China simultaneously contract, industrial manufacturing will hit a brick wall. The demand for new cars, new electronics, and new solar installations will plummet. If that baseline industrial demand collapses, the physical shortage temporarily disappears. Combine a severe global recession with a persistently strong United States dollar as investors hoard cash to survive the economic winter, and the paper price of silver could easily plunge. In this worst-case scenario, market models suggest silver could crash all the way back to its 200-day moving average, dropping into the mid-50s before it finds a true fundamental floor. So, what is the ultimate bottom line for the Wealth Reactor community? The silver market in 2026 is a total powder keg. It is caught in an epic tug of war. On one side, you have a ferocious, undeniable industrial shortage. On the physical side, we are simply running out of the metal. On the other side, you have a heavy, dollar-dominated headwind dictated by the Federal Reserve and the paper manipulators on Wall Street. If you believe that the industrial demand for green energy and artificial intelligence will overpower the Federal Reserve's interest rate games, then this current $78 level is not a crash. It is a generational buying opportunity. It is a final gift from the market before we launch into the triple digits. However, if you believe that inflation will persist, interest rates will remain elevated for years, and a crippling global recession is imminent, then you must be prepared for extreme volatility and a potential slide back into the 60s or lower. You must position your portfolio to weather that storm. I want to know exactly where you stand. Are you deploying your capital right now in preparation for a historic $300 supercycle, or are you sitting in cash, waiting for a brutal $55 crash? Do you trust the physical supply deficit, or do you fear the paper market manipulation? Drop your exact price targets and your reasoning in the comments below. I read every single comment, and I want to see what the Wealth Reactor community is predicting. Understanding these price targets is only step one. To truly understand why the massive institutions are so incredibly bullish behind closed doors, you need to see the supply chain data that the mainstream media refuses to cover. In episode 2 of this series, we are doing a deep dive into the industrial short squeeze. We will look at exactly how much silver the solar and AI industries are consuming and why the mining sector is completely failing to keep up. If you received value from this deep dive, do me a favor, hit the like button to help push this critical information through the YouTube algorithm, subscribe to the Wealth Reactor, and turn on the notification bell so you do not miss episode 2. Thank you for watching, protect your wealth, and as always, I am John A.G., and I will see you in the next breakdown.